Good morning and welcome to this ELI event, this webinar of the project team of the ELI Corporate Sustainability, Financial Accounting and Share Capital project. We will have a 2-hour discussion on the project that is underway at the European Law Institute. So first, let me introduce myself. My name is Corrado Maberti. I am one of the co-reporters of the project, and I am an associate professor of commercial law at the University of Trento. Today, we will have several speakers and also a Q&A session at the end. We will start with a presentation of the project itself at its current state of development, which is already quite advanced. And the project will be presented by Yuri Biondi, who is a co-reporter of the project. Yuri is a senior tenured research fellow at the CNRS in Paris. Then we will proceed with an analysis of the implication of our project for several countries, and also with regard to some countries that are not belonging to the European Union. And we will start with Anne Lehmann, who is a team member of the project and associate professor at l'École supérieure de commerce de Paris. She will present the implication of our project for several member states of the European Union. We will then move to experience of countries outside of the European Union, and in particular we will focus on the case study on Japan. In fact, in our project we have several case studies that we wanted to consider, but we believe that the Japanese experience is particularly valuable. The case study on Japan will be presented by Clémence Garcia, who is a project team member and a professor at Gokshun University. Akio Oshii, also a project team member and associate professor as well at Gokshun University. And Miyoko Takahashi, who is a professor at Hosei University. We will then have the third co-reporter of the project, Colin Haslam, professor of accounting and finance at Queen Mary University in London, who will deliver some concluding remarks on the discussion we had. And then we will also have a Q&A session with all the participants in this event. Please, as a person participating in this event, be aware that we have activated the chat, so you can ask your questions in the chat. And we will try to devote at least 30 minutes to this Q&A session. This means that our speakers will have about 20-25 minutes for delivering their presentations. I don't want to take any more time, so I think I can now give the floor to the co-reporter of the project, Yuri Biondi. Yuri, the floor is yours.
Thank you very much. Thanks, Corrado. Thanks to all the participants. And I will now share my screen. Let me see. I hope it will work correctly. Okay, slide. Can you see my screen? That's fine.
Yes, it works.
Thank you. Okay. So this is not the first time we present, but now the project is more advanced. So I hope that we can give you an understanding of the project and its progress. And it's quite final from the research team viewpoint now. So I think this will be really a fair assessment of its findings and tentative proposals. So we started working on this long ago. It was already in our mind when we delivered the green paper, which was established, was prepared in 2018. Which establish our work at the Business and Financial Law Special Interest Group at the European Law Institute, which is the main, the core driver, the main force behind this project. And the project was eventually accepted as such by the European Law Institute, and we are now expecting to submit it by September for the ELI endorsement. So I will give you a brief understanding of the project purpose, its output, the composition of the team, and I will focus especially on the finding, the assessment of the European policy option, and the current draft of the European principle of corporate sustainability. So our project intend to contribute to the global debate, I would say, but also especially European debate about corporate sustainability, which include environmental, social, but also financial considerations. So it's a really a combined dimension which involve being sustainable financially, to be actually sustainable from the environmental and the social viewpoint. And from our viewpoint, this corporate sustainability involves a company law and a financial accounting law dimension. So in our mind, what we call the common sense assumption on our project is that only financially robust companies can afford to respond and cope with environmental, social, and governance considerations. So if you want a company to assure investor and creditor protection and to respond to its commitments and obligation for social and environmental responsibilities, you have to assure that the company is financially viable through time. And so company law requirement, and especially share capital management, are the key instrument from the regulatory viewpoint to assure this corporate sustainability through time and circumstances. And from our viewpoint, it is quite an old-fashioned understanding, but financial accounting can be deployed as a convenient legal economic instrument to better inform and control this share capital management, and so also to enforce regulation concerning social and environmental responsibility by companies. So what we do at the European Law Institute through our project is that we have been working for more than 2 years now on a set of recommendations, which will be summarized in a statement of principle, which we call the principle of corporate sustainability. And we hope to contribute by this statement of principles to the general EU debate. So the idea is to point to company law principle, which will better harmonize the prudential capital management by companies and better control distribution to shareholders, which are essentially the key issue. Why so? Because if the financial robustness of companies is fundamental, as I have explained it just 1 minute before, At this point, you have to set a balance at the governance, the managerial and the governance level between the resources which are devoted to this task and the distribution to external parties, especially shareholders. And so this is essentially our main focus, but by doing so, by pointing to company law principle, which manage prudential capital and distribution to shareholders, we will also contribute to clarify the duties by director and auditors, and clarifying also the legal, establishing, if I would say, the legal security for their fulfillment of obligations toward the companies and society. Because of course we all know that the European Union has been deploying a set of very important corporate regulations on non-financial reporting and this green investment and more generally speaking, environmental responsibilities. And this will bring a new important set of duties on directors, auditors, and companies in general. And so working on the legal security and clarifying the legal perimeter of this obligation would be important. And through our work, we will also disentangle the key policy option for accounting law in Europe. And we decided that our statement of principle concern primarily company law and will at this point only require accounting adjustment. So in a way which is quite similar to tax law, if we want to make an analogy, as tax law require accounting adjustment to enforce its specific purposes. So our principle will require accounting adjustment to enforce this kind of prudential mission we want a company law principle to perform. We have prepared a first preliminary outcome at the academic level by publishing a symposium with the European Company Law, one of the three main company law journal in Europe that you can access online. And we have been working with a team of researchers or academics which were selected for their common interest in EU law and regulation, especially company law and financial law, of course, for this project. And the team is interdisciplinary and international. The three leaders, co-reporters are Corrado Malberti, which chaired the webinar today, and Collins Aslam, and myself. But we also have a large set of stakeholder representatives, which are agreed to assist us and to discuss with us about all these matters. And we try to balance academic and non-academic members among these advisors, which come from very important institutions, including the European Commission Informal Expert Group on corporate law and corporate governance, the France Accounting Authority, the Italian Supreme Court, etc. Our project, as in the first phase, which is now almost concluded, we developed several reports. So we point on empirical evidence on corporate practice. We review the legal framework concerning corporate sustainability in Europe and sustainability in general. We prepare, as Corrado has just mentioned, several country reports, Germany, Italy, France, and Croatia, on the specific company law and financial accounting provisions, which are our key focus. But we also prepared and discussed country reports from outside Europe, which provide comparative benchmarks and also useful and thoughtful and sometimes even insightful experience from abroad. Japan, which has a very interesting case of this connection between financial accounting and company law. And this is also why we asked the colleagues which worked on this report to present today. And of course, UK, perhaps Colin may say something more about the UK case study. And of course, the experience by European member states, which will be introduced by Anne Lehmann just after my speech. So our empirical evidence is quite in line with the accompanying studies commissioned by the European Commission, which were published in 2020, in which essentially those reports concludes that especially listed companies in Europe face huge pressure to deliver financial return in quite short-term time windows. Meaning the short-term is quite widespread and is a threat for companies which want to promote sustainable behavior and sustainable investments. A large part of income by those companies are distributed to shareholder investors, and this when this distribution become excessive, they could even be detrimental to long-term development of the company and to its sustainability over time. Of course, as we explained before, if the company devote too much resources to financial distribution, and if the company neglects to establish a proper long-term set of a sustainable investment and investment toward the sustainability missions, that company cannot balance between these social and environmental commitments and financial commitments, which are also a part of its, but not the only mission of the company. So based on this comprehensive review of the corporate practice, we also deliver a comprehensive review of law and regulation concerning corporate sustainability. And we can say that the backbones of this sustainable development idea, which is really prominent in the EU agenda nowadays, is the company as a going concern. So the idea that the company is a self-contained organization which must be sustained through time. So, and also the high level of protection of employees and creditor rights, which is very important in the EU legal framework, and the more recent notion of fostering sustainable investment, which of course include environmental concerns, but are not limited to them. Social governance and environmental concerns are all equally important in the EU agenda behind the sustainable investment. So the limits of this, the incumbent EU framework for corporate sustainability is that the current definition of capital management, so the capital maintenance regime for companies, doesn't refer to long-term sustainability, and is quite threatened by the regulatory competition between member states, because according to the Grand Acquis of the European Court of Justice, the least constraining regulation is to be preferred when transnational conflict occur. And so this also means that the least restraining, the least constraining member state will lead essentially the relationship between the different member states on these matters. And also the second point, which is also quite neglected, is that this company law regulation depends on financial accounting regulations. And since when the second directive was established, a new set of accounting standards were adopted in Europe. And that set has not the same organization, the same structure, and even not the same purposes as the accounting directive, which were developed along with the company law directive. And so this new dependency of EU accounting law on international accounting standard introduce current value measurement, so-called fair value accounting, and that fair value accounting may be less convenient for corporate sustainability purposes than the previous standards. So once this two analysis, so the threat by short-termism in company behavior and the limits of the incumbent EU regulatory framework for corporate sustainability, we have established a set of what we call policy inconsistencies. So if we want the law and regulation in Europe to promote corporate sustainability, we have to improve on the existing sets of law and regulation for corporate governance, which is still very dependent on the shareholder primacy and the shareholder value orientation, which is not sufficient when you want to introduce want the companies to consider other stakeholders in the environment and society at large in their corporate agenda. And also, you have to improve on the current approach to freedom of establishment, because we have this undue pressure on corporate sustainability due to regulatory competition, as I explained, but also the opportunistic use of transnational entities and transactions, including corporate groups and special purpose entities. And of course, which is our main focus, the received approach to legal capital, or what we call equity capital, because by this dependency on international accounting standards, and because of new types of distributions, such as share buybacks and reserve distributions, this received approach to company capital management can be and may be proved to be actually insufficient to protect the corporate sustainability through time. So these matters of these issues of policy inconsistency claim, for our viewpoint, to improve, to strengthen the harmonization at the EU level to avoid this detrimental regulatory competition concerning corporate sustainability and social responsibility of companies, but also to establish a better level playing field for both investors and stakeholder interest, which could complement or even improve, upgrade the received model of company management and corporate governance based on shareholder value and shareholder primacy only. So, of course, the company law agenda at the European level has been developing already, the Sustainable Corporate Governance Project I have mentioned, and they is not yet published. So we don't know exactly what the European Commission has in mind, but rumors say that they will point to enhance duties by directors on these matters, which is definitely welcome. And our project will recommend also looking at the rules on equity capital management, which would be a convenient a complementary dimension to be addressed. In addition, of course, these duties go along with clarifying rules for equity capital management and their measurements, so financial accounting adjustments. And in this context, so financial accounting is a convenient instruments. So we can point to how to better the reports on sustainability-related liabilities and commitments, and also how to better the reports on distribution and retained earnings, so reserve provisioning. So how we want to do this, the idea is to develop a set of company law principles which are concerned with company capital management in view to foster and facilitate sustainable business conduct. So we try to restate and modernize the well-established principle of European company law concerning legal capital, and improve the way they regulate distributions, equity capital management, and non-distributable reserve, including reserve provisioning. Of course, we don't pretend, they are principles, so we don't pretend to have the ultimate response to all this problem. But our set of principles may provide, first of all, a frame of reference to better understand what corporate sustainability means for companies, and so how company law can better deal with and cope with corporate sustainability. So it's a frame to be discussed, of course. So our contribution is to provide this clarifying dimension, this theoretical or conceptual clarification. We also want to point to specific issue, which from our understanding has to be addressed by EU member state, so European, let's say, both at the EU level, but at member state level, lawmakers and regulators. So of course, each principle, in a sense, point to a specific issue to be addressed. And we provide also a set of possible solutions which can be adopted independently or partly or even completely to deal with these issues. The European Commission has been working on these matters into its Green Deal, Green Finance Deal, which is this action plans called Financing Sustainable Growth. They want to introduce the sustainable corporate governance dimension in Action 10 and also reduce short-termism driven by capital markets. And they have been developing more financial market measures until the present, and the Sustainable Corporate Governance Initiative is still under development. It's the first initiative or main initiative going in the direction of companies, not only financial markets. And our proposal want to point definitely to this company dimension. And so how to introduce and how to assist and facilitate boards to develop and disclose a sustainability strategy. So our proposal is definitely in line with the sustainable corporate governance dimension of the EU Commission agenda, but also with company law provision concerning company capital maintenance, which we want to restate and renew. And in a sense, also with the no financial reporting, because we point to the financial dimension of corporate sustainability risk and commitments. And so these suggestions could be, of course, introduced as financial accounting adjustment for company law purposes, but also as improvement on non-financial reporting. The standards are not yet issued, so we contribute to the debate on how this non-financial reporting standards in Europe may be. So our understanding of sustainable business conduct is really something which is up to the board to decide. So the law in our company law is not there to impose a specific decision, but more to provide a consistent and fair set to level the playing field and to facilitate and foster sustainable business conduct by manager and directors. So essentially, under this common sense assumption that only financially robust companies may afford corporate sustainability, we ask the company board to balance between the various interests, so investors, shareholder interest, but also stakeholder interest and the corporate sustainability, or what is called in some jurisdiction, the interest of the company to be sustained over time. And this imply principal provisions for company equity management, non-financial reporting, and also financial accounting adjustment. Altogether, our principle recommend a prudent use of resources by manager, and also promote the constitution of the provisioning of sufficient reserve to meet social and environmental commitments. So the company is encouraged to establish a sustainability plan through time, and it's also already true, and us also to provide a financial plan which match and fit with this more or less ambitious social and environmental commitments. And of course, the social and environmental obligations, which are already in place. So the principle help to better control distribution and provisioning, which is this balance between shareholder interest in distribution and the interest of stakeholders and society in provisioning social and environmental plans. And also to establish a more long-term horizon, because by following our principle, the company is really invited to establish this plan and the financial accompanying commitments, and so as to say now what has to be done through years to match with these plans. Of course, a specific attention is paid to the new kind of distributions, not only dividends, which are the received core of company capital controls, but also the new kind, for instance, share buyback, acquisition goodwill, no realized gain from fair value accounting. All these are new problems for an old problem, so an evergreen problem with company capital management and distributions. So that's the new area that our principle cover. And to give you just two examples, for instance, when a company commit to a long-term investment plan, project for achieving some kind of environmental or social sustainability, our principle recommend to establish at the same time a provisioning plan to cover for the cost incurred or to be incurred to achieve this plan, under the idea of constructive obligation. And when a company realizes when a company recognizes in financial accounting a non-realized gain, for instance, some current value gain on holdings or financial securities, our principle recommend to set aside those non-realized profit in a non-distributable reserve, to avoid the distribution of public profits, so profit which are not realized. It could disappear if the current market price go down in the future. As long as the company has not realized those profits on the market, those profits cannot be included in the distributable resources. So to conclude, we want, through our principle, to restate and modernize, perhaps update, the well-established principle of company law management concerning distributions, equity capital maintenance, and non-distributable reserve and provisioning. Our principle want to contribute to the debate, to ongoing European debate on how to foster and facilitate sustainable business conduct through EU law and regulations. And we are especially concerned, and we want to contribute to the ongoing debate on sustainable corporate governance, company law provision concerning company capital management based upon the principle of going concern, and also the debate along the non-financial reporting by adding financial impact clarification on risk commitment related to corporate sustainability. So as I mentioned at the beginning, we plan to submit our set of principles to the ELI Council for approval by next September. And we will present our final set of principles at the ELI annual meeting in Madrid at the same time. And the next presentation will be in Zagreb by the conference organized by Anna Orak at the Zagreb Faculty of Economics, which is online. So the member of the ELI will be informed about this occasion. So thank you very much for your attention, and I look forward to the Q&A session after the other presentation. Thanks.
Thank you very much, Yuri, for this comprehensive presentation of the project in its current state. We are slightly running late. I think I should immediately give Juan Lemon. Dan, the floor is yours.
Okay, thank you very much. So I'm sharing my screen. Okay, sorry for that.
It works. We can see the slides.
Okay, so good morning, everyone, and thank you very much for attending this webinar this morning. So Yuri has just mentioned in his presentation a recommendation about imposing limitations on dividend distribution on non-realized gains. So this morning, I will present a summary of a study laid on current dividend distribution restrictions for public limited companies across Europe, included UK, because when the study started, UK was still part of EU. So very briefly, the content of my presentation will be the following. First, I will explain which financial statements are applied for profit distribution in Europe. I will briefly explain what are the legal basis of dividend distribution across member states. I will talk about the current requirement of a legal reserve that exists in some member states, and maybe main part of the paper, I will talk about unrealized gains and restrictions on dividend distributions that exist in Europe at the moment. And I will talk at the end about financial transactions that impact shareholders' equity, or Yuri has already mentioned them, and that could raise questions about distribution or not arising from these financial transactions. So first, let's talk about financial statements apply for profit distributions in Europe. So as you can read, it's written individual financial statements. So it means that in all member states, dividend distribution is based on individual financial statements and not on consolidated financial statements. This point is crucial because, of course, it is connected to accounting gap that apply to individual financial statements. And remember, the 2002 European regulation imposes the use of IFRS for group or consolidated financial statement when the parent company is listed on a European financial market. And for all other cases, included individual financial statements, member states are free to accept, to impose or not IFRS. So this table shows the current situation in Europe, and of course the situations has evolved since 2002. So I won't go through all these figures. I can answer questions after, but maybe the first line is maybe the most important. So as you can see, there are only 6 countries that still prohibit the use of IFRS for individual financial statements, even if the company is listed on the financial market. So Austria, France, Germany, Hungary, Spain, and Sweden. Another point is the situation of Cyprus. Cyprus is the only country that, on the contrary, imposes IFRS for all companies, no local gap. And for all other member states, as you can see here, the situation is very mixed. Okay, from some countries that accept both local gap or IFRS, okay, or countries that will impose IFRS for some specific companies, but prohibit them for others, and so on and so forth. So the situation is at the moment quite mixed across Europe, but of course, as said before, it could change in the next future. Maybe we can assume that more and more countries will accept IFRS in the next future. Second part of my presentation, the legal basis of dividend distribution in Europe. And first of all, I wanted to remind 2 provisions arising from the 2017 European Directive on the company laws about dividend distributions. So the first, I would say, provision is the following. the amount of a distribution to shareholders may not exceed the amount of the profits at the end of the last financial year, and plus available reserves, but of course less any losses brought forward and sums placed to reserve in accordance with the law or the bylaws. So this is the first requirement, existence of a distributable profit. The second provision is the following: no distribution may be made when the net assets of the company following the distribution would become lower than the total made of share capital and the reserves which may not be distributed. So this provision is often named balance sheet test. Okay? So the directive recommends to meet these two provisions. What is the situation in the member states' company laws? As you can see here, only 10 countries, I would say, comply exactly with the European regulation recommendations. And for other countries, it's a bit different. It means sometimes only one of the provisions is mentioned, and sometimes other specific provisions are added. For example, in Lithuania, it's not possible to distribute any dividends if the company fails to pay all the taxes it has to pay in following the deadline. So, and we can find other type of requirements in other countries. So, legal basis of dividend distribution. First part about the requirement of a legal reserve. So a legal reserve, as you may know, of course, is a reserve, a part of profits that can never be distributed to shareholders except at the closing up of the company. It can be used to offset losses or can be incorporated to the share capital, but can never be distributed. Legal reserve is not mentioned or required by the European regulation, but as you can see here, a majority of European member states requires a legal reserve, 16 out of 28 countries. And these legal reserves goes from 5% to 1/3 of share capital. It means that every year, company has to allocate a part of net profit from 5 to 10% to this legal reserve. And when the legal reserve, which is depending on the countries, 5 to 1/3 of share capital, there is no need to carry on allocating a part of profit to the legal reserve. So it's not so easy to find some common, I would say, specificity to the country imposing a legal reserve and countries that do not. But one maybe important thing is that Sweden in the past also required a legal reserve, but it has changed and it doesn't require anymore this legal reserve. So once again, this situation could change. Let's talk now about unrealized gains and restrictions on dividend distribution. So this is maybe the main part of my presentation, and maybe I would say the less easy, especially for those of you that are not accountants. So I will try to do my best to explain in details, but I will answer questions, if there are questions, during the Q&A sessions. So first of all, the Accounting European Directive 2013-34 explicitly refers to 4 optional accounting treatments for individual financial statements, for which it recommends limitations on dividend distribution. So recommends member states that would incorporate these accounting treatments in their standard to impose limitations on dividend distributions. So the directive mentions first capitalization of development costs, capitalization of startup or formation cost of companies, revaluation of fixed assets, meaning intangible, tangible, and financial assets, and the use of equity method to measure investments in subsidiaries when the parent company also prepares consolidated financial statements. But we are talking about the situation in individual financial statements. And we have identified 4 other cases of unrealized gains that could be recognized in individual financial statements, but for which the European directive is silent as regard potential restrictions on dividend distribution. The first case is mentioned in the directive. This is the fair value option for financial instruments, but the directive does not recommend any limitation on dividend distribution when the fair value option is used. And the 3 other cases are not mentioned in the directive, but as we will see later, can exist in the national accounting regulation. Deferred tax assets, actual gains on pension plan benefits, and unrealized gains arising from the measurement at fair value of investment properties. So if we try to understand what is the situation in terms of dividend limitations in European countries for all these, in fact, 9 accounting treatments. So to understand my table, in this first table, we can see only accounting treatments for which the European directive recommends limitation on dividend distribution. Okay, and here we see the percentage of member states that impose in their regulation a limitation on dividend when this accounting treatment is allowed. It means that some countries do not allow these accounting treatments. Okay, here only countries that allow these treatments are presented. And the first case is about capitalization of startup costs. And this accounting treatment is mentioned in the directive, exists in some European countries, but is not allowed under IFRS. You can see here that in this case, all countries comply with the European regulation recommendation. It's not possible to distribute dividends when startup costs are capitalized, except if a reserve that reaches at least the amount of non-amortized startup costs stays in equity. This is the same thing for development costs. This treatment is mandatory under IFRS. And you can see that a high majority of member states, again, comply with the European regulation recommendation. And this is still the same, a bit less, I would say, for revaluation of tangible, intangible assets and revaluation of financial assets through equity. I have split tangible, intangible, and financial assets just because the treatment is different under IFRS. This one is only optional under IFRS, while revaluation of financial assets through equity is mandatory under IFRS for some specific financial assets. In these cases, what does it mean? It means that the European directive recommends that a revaluation reserve stays in equity when a company decides to evaluate tangible, intangible, or financial assets. And the last accounting treatment is equity method to measure investment in subsidiary, which is also optional under IFRS. And surprisingly, a bit less than 50% of member states effectively complies with the European recommendation to impose a limitation on dividend distribution in this case. If we go back now to the other 4 cases for which the European directive is silent on limitations on dividend distributions, as you can see here, except for gains recognized in net income from the use of fair value for investment properties, where the majority of member states, effectively impose a limitation on dividend distributions. For all other cases, only a small part of member states effectively mention limitations on these unrealized gains when the accounting treatment is accepted under local GAAP or when IFRS are accepted in the countries. So as already mentioned by Yuri before, there is a kind of loophole here in the European regulation about these unrealized gains and also in member states regulations. And just to, as a conclusion on this part, I have tried to, in a way, categorize countries according to the number of dividend distribution restrictions that can be found in their regulations, according to the 9 cases identified before. Several comments from this classification. The first one is that the 6 countries that do not accept IFRS for individual financial statements are all included in a group qualified as conservative or relatively conservative, except Hungary. This is an exception. On the other side, European country from East Europe that joined the EU from 2004 and 2013, are all included in the less conservative groups, meaning groups imposing from 0 to 5 dividend distribution restrictions. Of course, these observations should be further investigated, maybe to better understand why we can observe this mixed situation across Europe. Last part of my presentation. So financial transactions that impact shareholders' equity and that could raise the question of dividend distribution, even if we are not talking about net profit. The first one refers to capital increase. So as you may know, when a company issues new shares, if the issue price is higher than the nominal value of the shares, the difference between issue price and nominal value has to be recorded in a specific account in the equity section, which is named share premium or additional paid in capital. And there is a question about can this share premium be distributed to shareholders or not? So of course, it's a bit surprising because we could say it's like share capital, so it cannot be distributed to shareholders. But there is no restriction mentioned in the European regulation as regards this share premium. Nothing is mentioned. So if we look at the current situation of member states, again, we see that the situation is very mixed. And 7 countries authorize the distributions of this share premium, while only 10 explicitly prohibit this distribution, and another group of 10 does not mention anything. And again, it's very difficult to find common specificity to these countries. For example, in the group of 7 that authorize the distribution, we find from France and Austria that are on the other part quite conservative in terms of dividend distribution. So very difficult to understand why it's possible in these countries to distribute the share premium. And the last point is about buyback shares. So what are the restrictions when a company holds its own shares? So something is mentioned in the European regulation, since the 2017 directive specifies that member states may require a maximum holding rate for own shares and stipulates that member states may impose restriction on dividends distribution when a company holds its own shares. What does it mean in practice? It means that the amount paid for these held own shares must be kept in equity. It cannot be distributed. And we can see here that this European regulation recommendation is is met by most member states, 23 out of 28. So it's great. This is part of our recommendation, as already mentioned by Yuri before. So I'm done, and I'm ready to answer to your questions during the Q&A sessions. And thank you very much for your attention.
Thank you, Anne. Apologies, I was trying to turn on my microphone for this insightful presentation. I really enjoyed it. I think I have a lot to talk about it later in the Q&A session. And I also invite the participants to submit their questions if they have any so far. Now we move to the case study on Japan. We have, as I told you, three speakers: Clemence Garcia, Akio Hoshi, and Miyoko Takahashi. So I leave the floor to them. I see they have some presentation. So please, the floor is yours.
Thank you, Corrado. So I'm Clemence Garcia, and with my co-authors, Akio Hoshi and Miyoko Takahashi, we will present a case study about Japan. Can you see my slides? Oh, it's not moving.
Yes, we can, but we see you're moving the
excuse me,
the
I'm
pointer.
going to change the screen.
Now
Yeah,
something
that's better. Okay, so the report about Japan is a very similar topic with what Anna has just introduced about the European regulations, or the regulation in several European countries about capital maintenance and dividend restrictions, except that in this report, we took a little broader scope about also the disclosure of capital equity. Because in fact, the financial reporting terminology is very important to define what we are talking about. If some items are not defined in financial reporting, it's difficult to make some regulation about these items. So this is why we took the view of including financial reporting along with capital maintenance rules. So why a Japanese report? Because this is an ELI project, so we're mainly focusing on the European countries. But in fact, Japan is a very interesting jurisdiction because it's a multi-accounting standards jurisdiction. I mean that in Japan, companies are normally preparing their financial accounts with local GAAP, with domestic GAAP, domestic accounting standards. But at the same time, they can choose IFRS or Japanese accounting standards for consolidated accounts, or US GAAP for the disclosure for the financial markets. So in the Japanese Companies Act, there is some consideration for this multiple accounting standard environment. And this is why I think the Japanese case is particularly interesting in this regard. Okay, so I'm going to leave the floor to Professor Takahashi first, so that she can talk a little about financial reporting. And next, I will come back. I will present the parts prepared by Professor Hoshi, because in fact, I'm speaking just a little faster than him, so that he's the brain for this topic. He's a specialist on company law. So Professor Takahashi, please proceed to your part.
Mute your mic.
Can you see my slides? Okay.
Yes, we can.
Hello, thank you for having me today. I will start with the general description of the registration regarding Japanese financial reporting, and then explain how capital is presented in the balance sheet under Japanese accounting standards. The accounting-related provisions in the Financial Instruments and Exchange Act and the Companies Act specify financial reporting for companies subject to these laws. Financial instruments and exchange Act aims to contribute to the sound development of the capital markets and the protection of investors. Under this objective, it prescribes the documents that companies should prepare to provide information to investors, with financial statements as a major part of the documents. It is specified that any accounting treatment that is not provided in this Act and the related regulation shall be in accordance with generally accepted business accounting principles. The Companies Act's accounting rules pursue two goals. The first objective is to provide access to company information by providing disclosure-related provisions. The second objective is to coordinate the interest of creditors and shareholders, placing more emphasis on the protection of creditors by providing dividend-related provisions. The Company Act takes the position that accounting treatments and the format of financial statements should comply with GAAP, while on the other hand, the protection of creditors through capital maintenance should be maintained within its unique area of regulation. Clemens will explain this part later. The core of Japanese GAAP are the business accounting principles and the accounting standards. The business accounting principles was revised by the Business Accounting Council until an independent standard-setting body, the Accounting Standards Board of Japan, the ASBJ, was established in 2001 to promote international convergence. In principle, GAAP referred to these Japanese accounting standards. However, as Clemens stated, foreign accounting standards like the IFRS are deemed equivalent to GAAP for financial reporting purposes on a consolidated accounts basis. But this is not the case for the non-consolidated individual accounts. Next, I will explain how the net assets section, including shareholders' equity, is presented under the Japanese accounting standards. Compared to the IFRS, the ASBJ conceptual framework emphasizes the importance of the realization principle of net income, defined as a release from risks of the investments. The reporting format of profit and equity consistently separates into realized and unrealized elements by disentangling those elements which are released from risks. Regarding capital presentation in the balance sheet, paid-in contributions and earned surplus are viewed as distinct from unrealized gains and losses. In line with this principle, the ASBJ conceptual framework defines net assets and shareholders' equity as two distinct concepts as follows. Net assets is the difference between the total assets and the total liabilities, while shareholders' equity is a component of the net assets attributable to the shareholders of the reporting entity. Net assets is an all-inclusive concept that encompasses some items that do not meet the definition of either liabilities or shareholders' equity. The English translation of the conceptual framework uses the term owner's equity, which corresponds to shareholders' equity for stock companies. In this presentation, we use the term shareholders' equity instead of owner's equity to avoid misunderstanding. In the following slides, I will show step by step how the net assets section of the consolidated balance sheet is presented under Japanese standards. The first subsection in the net assets section is the shareholders' equity or owner's equity. It includes paid-in capital, capital surplus, earned surplus, and treasury stock. Apart from dividend restrictions, there's a long tradition of disclosing the portion of equity contributed by shareholders separately from the past earnings retained by the company. The next subsection, which is the accumulated other comprehensive income, includes 4 items of unrealized gains and losses resulting from various valuation adjustments. Those items are valuation differences on available for sale securities, deferred gains or losses on hedges, foreign currency translation adjustments, and remeasurement of defined benefit plans. Rights to receive shares as compensation and subscription rights to shares are incurred by direct transactions with the subscription right holders who are not the current shareholders of the reporting entity. And minority interest represents the portion of a subsidiary's equity that are not attributable to the parent company. Since direct transactions with the subscription right holders and minority interest are not attributable to current shareholders of the parent company, these items are presented separate from the shareholders' equity. Compared with the IFRS format, 2 features of the Japanese reporting model are noteworthy. First, Japanese format is more precise regarding the presentation of equity and place particular emphasis on clearly delineating the boundaries of shareholders' equity in financial statements. And that realization principle of net income plays an important role to separate realized items included in the shareholders' equity from unrealized items included in the accumulated other comprehensive income subsection. Second, as it is not always the case for the IFRS, Japanese standards require systematic and mandatory recycling of OCI items to the income statement at the time of realization. In other words, the subsection accumulated other comprehensive income comprises temporary items that are eventually transferred to shareholders' equity at the time of realization as part of profit or loss. Last but not least, it is important to note that when OCI items are not recycled to profit or loss at the time of realization, we will no longer be able to consistently separate realized and unrealized elements of equity in the balance sheet. Next, Clemens will explain the Companies Act provisions on capital. Thank you.
Just 1 second. Oh. So about the Companies Act provisions, there are 3 main aspects. The first one are the disclosure-related provisions. The second one is dividend-related provisions. And the third one are other transactions with shareholders. For the disclosure-related provision, it is interesting to note that the Companies Act has been harmonized with all the different changes in financial regulation regarding accounting disclosure. And so the reporting format in the Companies Act is more or less consistent with what Miyoko has just introduced for financial reporting. Now, the relationship between the Companies Act and financial reporting is very interesting because, in fact, the purpose of these 2 sets of legislations are not exactly the same, since the Companies Act focuses more on creditor protection compared with financial disclosure, which is more for market participants. But at the same time, the Companies Act provides the underlying legal concepts of equity items like reserves, like stated capital, etc. And these definitions are not included in financial reporting standards, or there are some definitions, but not as precise as the ones in Companies Act. And also the legal regimes of these items are in the Companies Act. So the two legislations are very interrelated. They are depending on each other. So, and the second point is, as I said before, the reporting format for equity elements is harmonized between financial reporting for financial markets and the Companies Act, but there are still some minor differences in terminology. I think in a meeting before, I said that we had trouble sometimes translating the different words because there's an official translation in English, but it's not always consistent with the contents of the items. So there are some minor issues with terminology. And also there are some more precise rules for individual accounts, because in individual accounts, there are some items that are not necessary in consolidated accounts, like the legal reserves, etc. Okay, now for dividend related provisions, there is a very, very, very complex set of rules in Japanese Companies Act in order to determine the distributable amounts. And the reason why these rules are complex is not that much because of the multi-standard environment, multi-accounting standard environment, but rather because there's a two-step approach. One first step that is meant to determine the surplus that can be distributed. And this first step is based on accounting adjustments, like, for example, cutoff rules. After you have closed your accounts, what kind of adjustments you have to do to determine the available surplus. And there's a second step that is specific to Companies Act. So the second step that is the computation of the distributable amounts based on Companies Act rules, and that is aimed at protecting creditors' interests. Okay, so financial accounting is more investor-oriented, but the rules on the second stage, for the second step of dividend-related provisions in Companies Act are aimed at the protection of creditors. And in these rules, you can find the same kinds of adjustments as Anne has introduced for the European countries, like, for example, goodwill cannot be distributed, treasury shares must be deducted from the distributable reserves, etc., etc., etc. This is the same idea as, for example, the German company law, or even the French company law is a little similar in this regard. Okay, so this is about dividend limitation, and there is one more particularity that is, I think, very unique to Japan, but that is not very common in practice, even for large listed companies in Japan. From 2005, typically in Japan, the dividend restrictions are based on individual accounts, but since 2005, the listed companies or the large companies can opt for a specific system, that is the consolidated dividend system, in which there is a double limitation on dividends. So, for example, if a parent opts for consolidated dividend system, there is a limitation on the distributable reserve based on consolidated accounts and on individual accounts. So both are limiting the amount of dividend. This system is aimed at the regulation of procedures regarding intra-group restructuring and stock acquisition. So it was not directly aimed at changing the dividend system as a whole, but it was part of a broader reform regarding different procedures of approval in shareholders meeting, etc. However, in this double dividend limitation system, what is, I think, very interesting in terms of regulation and in terms of defining the distributable amount is that even companies that are using IFRS for their consolidated accounts have to comply with Companies Act provisions regarding the computation of the distributable amount, which means that some concepts that are specific to Companies Act and that do not exist in IFRS have to be used and have to be, the criteria have to be met for a company to be able to distribute dividends. Okay, so this is about this double dividend limitation. As I said before, this is not very common in practice, but I think it's an interesting example because you can use several accounting standards and still fulfill the requirements of the Companies Act. Other transactions with shareholders. In fact, in Japan, the Companies Act or commercial law before Companies Act was very, very conservative, and the share buybacks and stock options were almost forbidden until 2011. So these transactions with shareholders is a very recent issue, and it has gradually been liberalized in the years 2000s, with especially the introduction of some new items in financial accounting. For example, treasury shares, rights to receive shares as compensations are some new items that have been introduced in financial reports to reflect these new types of transactions. In any case, both types of shareholder transactions are clearly disclosed in financial statements, which is, I think, more transparent for shareholders. Okay, so I will conclude briefly and let the floor to Professor Akio Hoshi, because I think he has very interesting insights about the system as a whole. So if I can just conclude about the report. The financial reporting and dividend restrictions in Japan are governed by the Japanese Companies Act and the Financial Markets Regulation, which is the Financial Instrument Exchange Act. And these regulations are consistent and complementary with each other. There are some minor differences because the purpose of the two are not exactly the same, but these differences in purpose are solved with a two-step approach in the dividend limitation. If we would like to use the same approach with IFRS, maybe this would be possible, provided that European company law sets some underlying concepts regarding capital items. And next and last, please, Professor Hoshi, take the floor.
Thank you, Clemens. I'd like to point out two striking features in the area of financial reporting and distribution regulation in Japan. The first feature is a possible separation of accounting standards that apply to consolidated financial statements and individual financial statements. In Japan, even the companies that apply IFRS for disclosure purposes are required to prepare individual non-consolidated financial statements in accordance with Japanese GAAP. This is because distribution regulation under the Companies Act and the corporate income tax calculation under the Corporate Tax Act are both built upon the accounting concepts of Japanese GAAP. From the perspective of the entire Japanese legal system, it is relatively easy to accommodate the international standards of financial reporting because it concerns only about large or listed companies that need to raise money from a wide range of investors, including foreign investors. By contrast, both distribution regulation and income tax calculation apply to all the companies in Japan, including small and medium-sized companies. They are local existence and they are comfortable with complying only with local standards. The possible separation of applicable accounting standards between consolidated financial statements and individual financial statements is a result of reconciliation between accommodation for global investors' needs for standardized financial information and accommodation for local companies' needs for their compliance with distribution regulation and tax calculation. This is the first point. And the second point is that the rules of calculating distributable amount are very detailed and formalistic in Japan. there seems almost no room for managerial discretion for the calculation. Put differently, Japanese law adopts a rule-based approach towards this issue. As widely known, a rule-based approach has the advantage in the situation where the same event takes place broadly and repeatedly. The calculation of distributable amount, as well as the calculation of corporate tax amount, is one typical example of such an event because all the companies, Japan has 2.5 million stock companies in total, all of them are required to comply with distribution regulation, and dividends are paid many times during the life of a company. In such a situation, Japanese law believes uniform and consistent treatment is important. In other words, without fear of a misunderstanding, if a computer program can calculate the distributable amount, that's fine, even if human being does not understand the exact rules of calculation. This idea is sharply in contrast with the calculation of profits and losses in accounting, where the quality of financial information is much more important. As individual companies are in different earnings environments, certain managerial discretion is inevitable for producing good financial information. So to me, a principle-based approach in accounting area seems appropriate in many cases in setting accounting standards. That's it from me. Thank you.
Thank you very much. I don't know if Clémence would like to add anything else.
No, thank you. I will keep the time for the discussion.
Thank you very much. We already have a question in the Q&A to which both Clémence and you provided an answer, but we will come back to that later because it is really interesting what is written in the question. And I would now give the floor to Colin Haslam, also co-reporter of the project, to conclude, I would say, this webinar before moving to the Q&A session. Please, Colin, the floor is yours.
Okay, thank you very much, Corrado, and thank you everybody for your contributions. I suppose what's absolutely clear is that there's no consistency or clarity over what constitutes distributable profits in company accounts, because the distributable profits can be manipulated through both realized and unrealized gains. and the rules governing the categorization of what is an unrealized or realized gain is also very opaque. I mean, the ICAW technical regulations governing distributable profits runs to 128 pages, and that tells us something about the possibilities of ambiguities around the distributable profits conundrum, really, that we all face in terms of trying to put a boundary around what's distributable and what's not distributable. And then I think also we have the other side of the coin as well, which is the net assets rule, which again, is problematic. That is, we argue that, there is distributable capacity where the net assets exceed the undistributable reserves under UK company law, and that's consistent really with EU regulations. But of course, distributions are out of the realized and unrealized gains, but distributions are also corrupted by the net assets rule, which allows companies to reduce their capital through capital cancellations and also share buybacks, which is another means by which the capital can be reduced and repaid to the shareholders. So that if I manipulate my undistributable reserves by cancelling capital and reducing capital, then my net assets rule now works because my net assets are greater than the undistributable reserves, and that facilitates even more distributions. And so in the paper we're putting together for the sort of UK case study, we have companies right on the extreme where they're issuing new share capital to purchase another company, and that also carries with it additional share premium. So the company has issued the paper to purchase the other company. Once that's achieved, the share premium account is then cancelled through a capital reduction, and those funds made available to the shareholders. So we call that a capital reduction, not a distribution, but in effect, it's a distribution. It's operating in the same way. But I may then not have sufficient cash to pay that because it's a large capital reduction, but I borrow funds to do that. So I'm manipulating my cash flow statement to facilitate the distribution and the repatriation of assets to the shareholders. So in two senses, what we're looking at are two components of the Companies Act, wherever we are, that are sort of like leaky buckets. The distributable funds in terms of realized and unrealized gains, where there's corruption between the two. And then the net assets rule, which can be corrupted by the capital reduction capabilities of companies in terms of share buybacks and petitions for capital reduction, which allows me to meet the net assets rule and evacuate assets out of the company. And I think this project is absolutely essential in terms of trying to put a boundary, a tighter boundary around those two elements of the fundamentals of company law and distributable assets. The main reason for that is that we need companies to survive as going concerns and commit themselves to a sustainable future, which is what Yuri brought us to at the beginning. So at the end of it all, we need to close these gaps down, limit the possibilities for asset leakage in order to preserve sustainable companies going forward that are committed to carbon reduction and the social and environmental goals that we're all looking for from our corporate sector. Thank you, everybody.
Thank you very much, Colin. We have now 30 minutes for the Q&A session. We have first a comment by Richard Murphy, who is highlighting that there are also other projects that are trying to achieve the same goals that are advanced by our project. To my understanding, this project comes from the United Kingdom. So I would like to ask the panelists, Yuri or Colin, probably, if they are aware of this project and if they would like to give feedback on what can be the synergies between the document that is mentioned in the Q&A section and our project. Colin, Yuri?
Perhaps Colin is the best student if he knows the project. Otherwise, I was very glad that Richard has shared this project with us. I was not aware. I'm aware, and Colin keep us informed about the interest for this subject, which is really emergent and increasing in UK. And also our review of corporate practice has shown how UK is exposed as other listed company in Europe on this short-termist practice and all this problem with commitments to sustainable commitments to social and environmental responsibilities. And also in drafting our principles, we have studied and critically reviewed the rules that the UK, the England accounting authorities prepared KIW as prepared to deal with this distributable amount and distribution to shareholders, because of course they are aware of the problem, and by its own intention, actually, the IASB and the IFRS Foundation decide not to address the problem because they consider that distribution are outside the scope or their work. And so, okay, an accountant could say that the best way to address it is to include it into the financial reporting standards, because when you decide how to how to prepare the accounts, it will be easier perhaps to identify which part can be considered distributable, so realized, not realized. Obviously, was the way the accounting standards or the accounting models were developed by identifying through the realization principle which part of the profit is realized. But they decide that information to investors doesn't require to include such an information. So they left, they disconnected, let's see, as they say, the international accounting standard from the regulation and the definition itself of distributable profit. And this is why, of course, jurisdiction around the world has to address this problem independently from the ISB and the IFRS position. Thank you.
Thank you very much, Yuri. We have two other comments, one from Branko Jutic and another from Robert Bray. They are not much questions, but just, I would say, positive reactions to the presentations and to the general content of our project. Maybe, if I may, I would like to ask two questions. One to our colleagues from Japan and another to Anne Lehmann. Starting, if I may, obviously, I see we have also other questions. We'll come back to that immediately. To Anne, very quickly, do you think it would be better to address these issues by modifying? This is really a legal question, I would say. By modifying the directive on accounting or by modifying the codified company law directive, because there is this interplay that is always difficult to manage in practice. And to our Japanese colleague, I would like, to our colleagues from Japan, I would like to ask, can you tell us something more about this consolidated dividend system? Because if I understand it correctly, it essentially will further limit the ability of companies to dividends, because you have to comply with two different tests and not just with one. So why, if it is an elective test, companies decide if they have to opt in for this system, why do they decide to do that? And there are many companies that do that.
Okay, so first question for me is a difficult question. I don't have any answer, but it's true that it's quite complicated to always understand the connection between the provisions of the accounting directive and the provision of the company law directive. And this is the same thing when we investigate into a national regulation, always the connection. Sometimes it's in the accounting part, sometimes it's the company law. So I don't know. I'm not. I'm an accountant, so I won't give any advice about legal stuff. But I think it would be better if everything was included in the company law directive. As for me, it would be better for everyone. But this is only my point of view. It would be easier to understand. And maybe to be implemented in the national companies. So,
thank you very much. It will also be a way to, I would say, attract more the attention also of company law scholars and not just of accounting scholars. Clemence, Akio, Miyoko, do you have a?
I think the best person to answer the question would be Akio.
Okay, so in Japanese dual dividend regulation system, actually this is optional regulation. So the companies can choose the dividend regulation based on the individual accounts or this consolidated accounts. But the one important feature is this consolidated dividend regulation is works as only reducing the distributable amount. So if the company has lower distributable amount on the individual accounts basis, it's not important whether to apply this regulation or not. So only if the amount of distributable amount based on the consolidated accounts is lower than the amount based on individual accounts, this regulation has the sense to reduce the distributable amount. And the reason why Japanese law adopted this kind of one-way system is the idea of accounting conservatism. In essence, this regulation is similar to apply equity method in subsidiary shares in a parent companies. But in light of the accounting conservative, many conservative accountants don't like using equity method in evaluating the fair value of subsidiary shares. And in the dividend regulation, as Mihoko said, the unrealized gains are not included in the distributable amount. So so upside adjustment is not allowed, but downside adjustment could be allowed under the idea of accounting conservatism. So this is the reason why we are using this one-way adjustment system.
Thank you very much.
If I can just add one small point about this double dividend limitation in practice, there are really very few companies that choose this system because, in fact, it allows them to simplify their internal procedures regarding the approval of shareholders for certain transactions related with equity. It's kind of a set of different provisions that imply to use this double dividend limitation. So it's not really the double limitation per se that is attractive to companies. It's rather the consequences of this system. And there are a few companies, I think it's about 20 companies, if I'm not mistaken, that are using this system at the moment.
Very much to both of you for this answer. We have now a question by Karen van Moorik, to which Colin would like to provide an answer. Do you have any data on the extent of differences in dividend distributions, perhaps indicating differences by country?
Yes, and if Kirian wants to get in touch with me, I can send him some data as well to look at. And we've looked at this information across the top 600 companies in Europe by scale and size, and we've also looked at this in the case of the US S&P 500 over many years as well, and distributions not just in terms of dividends, but also in terms of share buybacks and adding those into the distributional mix. And also cash acquisitions, which we're now adding in there, because that's another mechanism for repatriating cash to shareholders. And then we're also logging now, both in Europe and also in the US, and that's taking more time on capital reductions that are taking place as well.
Colin, did you see any pattern in this study? So maybe some countries tend to be more
yes, the pattern,
ready.
yeah. the pattern is generally European companies are much more dividend distribution intensive than, say, US companies. US companies tend to distribute more of their funds as share buybacks than dividends now, and that's been consistently so over the last 10 years. And that's because, you know, dividends have a sort of a double identity for shareholders. The shareholder receives the money from the share buyback, and the company can use the treasury stock to as a currency to purchase companies, or in the mix of currency to acquire a company. So the treasury stock acquires a sort of double identity. It's both returned money to shareholders, but also an asset on company's balance sheet that can be used in exchange for other companies. So in the US, share buybacks exceed dividends. In Europe, it's the other way around. Dividends exceed share buybacks, but the pattern of share buyback intensity is increasing in Europe as large companies see the double advantages of using share buybacks, both to repatriate cash to shareholders, but also have a reserve of treasury stock that can be used and applied to part fund company acquisitions.
Thank you very much. Karen Hatz, I was trying to understand if there is a problem in practice as well as in the rules, also differences within the EU. By the way, apologies, Karen. Essentially, Colin, do you have anything to add on what could be the differences within the European?
Okay, so understanding why there's a difference between, say, dividends and share buybacks within the European Union. I think that in a sense, the European Union and companies within the EU, I would say, are generally much more sort of dividend biased in terms of the repatriation of cash than share buybacks. That's been much more active and well developed in the US for sort of many years. But in the UK, share buybacks are becoming increasingly important. So there tends to be a more Anglo-American axis when it comes to share buybacks relative to dividends. And then in Central Europe, a much more conservative dividend policy rather than share buybacks.
Maybe Anne could also say something about that, because she was mentioning that in Eastern Europe, on the other hand, there.
Yeah, no, I have not investigated the different distribution dividend policy across Europe in practice, but maybe to give maybe further explanation, I don't know, Colin, but could be an idea. As for me, the difference between Europe and the US in terms of buyback shares could be also explained by a difference in terms of tax for investors. Because it could be, for example, in France, I just know France, this is the same thing. For the investor, taxation would be the same for dividends or share buyback. But it could be that in the US, it's more interesting for investors to have buyback shares instead of dividend. I don't know, it's maybe.
Yeah, I think that there's another issue, which is that we've got to remember share buybacks are not a distribution, they're a capital reduction, and they're not treated in any of the Companies Acts in Europe or in the UK as a distribution. They're excluded from the list of distributions, and that's because they are a capital reduction. And I think that if you can use share buybacks to reduce capital, then you also facilitate your net assets rule, which is that you can then promote a more aggressive dividend distribution policy, because the underlying share buybacks are deducted from the undistributable reserves, which means your net assets are greater than your undistributable reserves, and that can promote a more aggressive dividend distribution policy. And we do see in countries where share buybacks are more active, the level of distributions distributed as a proportion of net income are very high.
Thank you, Colin. Your comments are also supported by Richard Murphy, who says that the tax is a key issue buybacks. The US provides favorable incentive here, not really found in Europe. And there is a question by Edita Erk regarding the attempts of international bodies like the IFRS Foundation to develop a kind of index that would, for example, take into account investment in environmental aspects or business. So to what extent the IASB has been involved, for example, in this debate on sustainability? I guess that maybe Yuri has a feedback on this.
Thank you. Yes, if I understand correctly, because you talk about index, Edita, and this puzzled me. But if we talk about the rules, the accounting standards for environmental investments, environmental commitments by companies, definitely this is a very important issue, and the IFRS Foundation has recently announced the establishment of a special body which will double, in a sense, and join the IASB. So they will now have two bodies. One is the International Accounting Standard Board, which developed the IFRS, and another one which is just established and it didn't start working yet, but has been announced to issue non-financial reporting standards. And perhaps they will address these issues. What we know that they have been advocating an approach based on enterprise value, which seems a more financial investor orientation, and which differ from the way we decide to address the problem, which point to the idea of the company as a going concern, and so take a more specific corporate and corporate governance perspective. But of course, we don't know yet which standard, how they will evolve, and which standard they will issue. And of course, the European Commission has also delegated the EFRAG, which is the European body for consultative body for accounting standard making, to generate a set of European standards for non-financial reporting, because now non-financial reporting is compulsory for European companies, and so the standard has to be provided for this new obligation, reporting obligation. And again, this is under development, so we don't know the context, but we definitely want to contribute to the European debate on those standards by pointing to the specific company law needs concerning distributions and reserve provisioning on environmental and social commitments by companies. Thank you.
Thank you, Yuri. To my understanding, we don't have other questions that are currently unanswered in the chat, in the Q&A. So maybe
Corrado. Yes, excuse me. May I just add one point about the scope of the project? Because I think what Yuri said was very interesting about the relationship with other standards, with other sustainability accounting standards. And I think that one very important point that maybe I didn't stress enough about the case of Japan is that the scope of reporting is not as large as the scope of reporting in some European countries. I mean that the reporting obligations change depending on the country. And in some countries, like for example, France, the reporting obligations are very wide, while in Germany, the reporting obligations are much less than that. So even if we create some accounting standards or sustainability accounting standards for large companies, there's still the issue of the smaller entities that is not really addressed, I think, at the moment by neither the IASB and the EFRAG. We don't really know at the moment what is going to be the scope of this new sustainability accounting standards, but still, I think there's a big loophole in the current focus on sustainability reporting, which is that only the large companies have to disclose a lot of information, while the middle-sized companies are not really addressed. And company law could, to some extent, help, at least for financial sustainability that we have addressed in our project, and could help the debate, at least in this regard.
Thank you, Clemence. This is really a hot topic, especially in the European Union, because the obligations on SMEs are quite broad. But Colin, please.
Yeah, I agree with Clemence. The issue and challenge going forward is that we need the foundation and platform of financial viability and sustainability. And then beyond that, we've been doing some work on, for example, audit assurance around banks' non-financial disclosures. And auditors will not give any assurance. They'll give very light assurance around non-financial disclosures. And that's because the information is very difficult to obtain and verify. And in relation to banks' exposure to carbon risk, it's a very difficult issue to methodologically underpin, because you're mixing both the exposure to carbon with future transitioning investments. So there's implicit offsets in the methodology. So the methodologies plus the lack of assurance from audit means there's a substantial challenge with regards to non-financial reporting. Whereas I think that where we're positioned vis-a-vis financial reporting and financial viability and sustainability, that's the essential first stage platform that needs to be put in place. But there's a huge debate then that follows, which is how and what non-financial reporting would be useful, and how we're to put that together for different activities. And with banks, which is a work we're doing at the moment, that's extremely challenging, because banks are being asked to explain their exposure in terms of debt and equity positions in a whole range of companies that they have investments in. And that's proving extremely challenging.
Thank you, Colin. Any other comment?
Perhaps if I can add on Clemence's remark, I think it's important to remember small and medium enterprises and their specific needs. But I want also to stress the use of special purpose entities, which complicate the picture. Because, of course, by the principle of the autonomy of every single company, every legal entity acquires this specific status. But in our case, of course, is the company is empty of its economic substance, cannot afford, and if the risk, of course, are insulated into an entity which cannot afford to bear those risks. Of course, this is definitely a structural opportunity in a clear way to circumvene social environmental obligations. So we always have to be very careful when we look at the scope, of course, and the way we apply, and to make the difference between the use of the void legal entity, let's say special purpose vehicles, from the real need of small and medium enterprise, which are enterprise indeed. Thank you.
Thank you, Yui. I don't see any other comments in the chat. So I would like to ask the speaker if they would like to take the floor. Otherwise, I think we can conclude this webinar here. So I would like first to thank the Secretariat of the European Law Institute and the European Law Institute for organizing this webinar, the speakers. that made really interesting presentations today, and also obviously the persons that took their time to participate in this webinar. The recording will be available the recording of this webinar will be available on the website of the European Institute. So if you like to listen again to the presentation that were today, you will have the opportunity to do that. So thank again to all the participants. Good afternoon or good evening, depending on where you're based. And it was a pleasure webinar on the project that we are, I would say, carrying on at the European Institute. Thank you very much.